Hi, thank you for taking a few minutes to watch this. My hope is that the information I've pulled together for you from some of JP Morgan's research will be helpful to you during this time to maintain your long-term perspective in the midst of the deluge of economic data you're probably hearing on a daily basis. I would like to start with a broad look at the S&P 500 over the past 2 decades, showing both volatility and progress. This will provide a good perspective for our overall discussion. The chart shows the price of the S&P 500 since 1996, annotating values at key points and including a box with valuations during prior market peaks. Overall, it's been a pretty spectacular roller coaster. We start in 1996 with the market rising over 100% to hit a peak in March of 2000. It then fell by 49% over the following 2.5 years before rallying again another 100% to hit a peak in October of 2007. Then we lived through the global financial crisis, in which the market fell more than 57% to hit its low in March of 2009. Since then, we have rallied with some intermittent drawbacks to over 300%. So that moves us to the next takeaway I'd like you to have. The key point in this next slide is that long-term investors should not overreact to short-term volatility. The bars in the chart show the price return for the S&P 500 for each year since 1980. The dots, the red dots, show the peak to low decline each year. The dots are somewhat inevitable in a healthy market. The market does not move in a straight line, and each year will contain some sort of correction. In fact, the average peak to low decline over the last 40 years has been close to 14%. Despite this, 75% of the time, the market ends the year in positive territory. We would expect volatility to increase as markets continue to mature. But the message is clear. History is heavily on the side of those who do not overreact to volatility. Now we will consider the equity stock market volatility since the financial crisis. This chart on the top shows the price level of the S&P 500 since 2010 with the major drawdowns annotated. The chart on the bottom shows the volatility index measure over the same time period. Notice the spikes in volatility as well as the notes that provide market commentary as to what was happening in the world during that time to cause those spikes. A few things are clear. Market corrections are not infrequent occurrences, but the source of that volatility is constantly changing. Over time, volatility subsides and markets resume their upward ascent. This chart can provide some good perspective on where we have been and where we might be headed going forward. As we consider where we have been and where we might be headed, this page provides us with additional perspective as to what we may expect. On the left-hand side, you will see a chart that shows that from the peak of the S&P 500 on February 19th through April 13th, the S&P 500 declined by 18%. If we look at this chart over here, it will demonstrate how much of a return is needed for a given time frame to recover to that peak. For example, if our time frame is 4 years, we would require an annual return of 7% to make it back to the peak. On the right, you can see the average returns around a bear market based on the previous 4 bear markets, some of which we've already discussed. The 12-month, and what I want you to notice here, it shows 12 months prior, it shows how far it falls during, and these are markets, different market trackers. So I want you to pay attention to the S&P 500. If we look at the S&P 500 coming down, then we can see the 12 months following the bear market. At least in these last 4 bear markets, we've seen an average return of 40%. So as you consider the 2 of these charts together and what we've already seen, I invite you to ask yourself the following question. Is it likely that I will achieve my goals if markets behave as they historically have? So far, we've only considered the U.S. equity market. Let's look at what happens when we consider owning bonds in combination. This page speaks to the importance of time and diversification. We show stock returns, bond returns, and a 50-50 mix. That's a simplistic version of diversification. This shows the very best and the very worst returns for each of the different time periods. The 1, 5, 10, and 20-year rolling time frames. The first observation is simple. If your time frame is only 1 year, almost anything can be expected from the stock market. We have seen returns as good as 47% on the upside and as bad as 39% on the downside. A large range of outcomes is possible with a 1-year time horizon. When we are using stocks in a portfolio, it is important to have a longer-term time horizon. Looking at the 5, 10, and 20-year time horizons, we see the range of outcomes shrinks in size and is much more positive. Lastly, zooming in on the diversification strategies, so that's this last one here, you can see that it never had a negative return during the rolling 5, 10, and 20-year time frames, thus making the case for diversification and time to diminish risk and volatility. Finally, let's tie it all together. This final page speaks to the importance of diversification and to the possible damaging impact of behavior. The 2 blue lines right here represent a 40-60 and a 60-40 stock bond mix, while the olive green line simply represents the S&P 500 alone. The punchline is while all 3 of these portfolios end up in more or less the same place, the ride is quite a bit different. While the S&P 500 lost about 50% of its values, we're going to look right here, during the financial crisis, the diversified portfolios lost half as much as that. As well, the diversified portfolios had much smoother rides upwards since then. And we can see that those were ahead through the diversified portfolios, because they didn't have such a severe loss, were ahead through October of 2016. And we've still recovered in all of those to date. Looking at the chart on the bottom, there's an orange box on the far side labeled Average Investor. This is based on an annual study by an organization called Dalbar, which measures the totals and timing of mutual fund flows by individual investors. Now, unfortunately, year after year after year, the conclusion is the same. Due to emotional and behavioral biases, mutual fund flows of the average investor have received a return of only 2.5% over the last 20 years. This is significantly lower than the 10 other asset classes that we show on this page. The orange bar shows what happens when investors do all the wrong things at all the wrong times for what seem like the right reasons. On the left-hand side, by contrast, a simple 60-40 blend of stocks and bonds shows much better results. So the message I would like to leave with you is this: the average investor should leave emotions out of their financial decisions. Have a plan and stick to that plan. Reasonably, this plan should involve some form of diversification. In the face of volatility, having a plan, time, and diversification are crucial to recovery in the economy that emerges.